All right, let's dive in. Today, we are tackling a really interesting and, let's be honest, super tempting investment that's been making waves. It's an ETF with the ticker MSTY. Now, if you're the kind of person whose eyes light up at the sight of a massive dividend yield, well, you're going to want to stick around for this. And wow, this quote just hits the nail on the head, doesn't it? It perfectly captures that magnetic pull of an investment that just seems too good to be true. So the big question is it? As with pretty much everything in the world of finance, it's a little complicated. Let's get into it.
So what's the deal with MSTY? Why is it so attractive to begin with? What is this big, flashing, free money sign that pulls so many people in? Well, it all comes down to one very powerful, very seductive number.
And there it is, 12%. I mean, when you see a yield like that, it's almost impossible not to get a little excited. Think about it. The S&P 500's long-term average total return is somewhere around 8 to 10%. So when an ETF struts in promising to pay you a whopping 12% dividend, your brain just starts doing the happy math.
And this is exactly what happens. Those big, juicy dividend checks start hitting your brokerage account, and for a minute, you feel like you've totally cracked the code. You feel like a financial wizard. But, and there's always a but, isn't there? That feeling is often incredibly short-lived, because the dividend is just one piece of the puzzle. The other piece, the total return, often tells a very, very different story.
So here's the absolute key. A yield this high isn't some gift from the investing gods. It's a warning. It's a giant flashing red flag telling you that there is some serious risk hiding just under the surface.
And this brings us right to the heart of this whole explainer, what we call the sucker yield problem. So what exactly is the catch with a yield that looks this incredible?
Okay, here's the textbook definition. A sucker yield is a payout that looks absolutely fantastic, but it's not being funded by sustainable growth or profits. Instead, the fund is often just giving you your own money back. It's chipping away at your original investment to pay you that dividend. And that, my friends, almost always leads to a negative total return.
Let's make this super simple. Imagine you get a dividend check for $100. You're thinking, awesome. But what you might not see is that the value of your shares just dropped by $150, so you're actually down $50. As the source material puts it so beautifully, your portfolio just got mugged.
You can really think of it with this simple, brutal equation. That high yield you're so excited about, it's really just a combination of low growth potential, a whole lot of underlying risk, and yeah, almost certainly a big old dose of future regret when you finally look at your account statement.
Now, all of this seems pretty logical, right? The math isn't that complicated. So the next big question is, if it's such a bad deal, why do these products stay so popular? Well, for that answer, we have to step out of the world of spreadsheets and into the fascinating world of human psychology.
Seriously, why do we keep falling for this? If it's such a flawed bet, why are we drawn to it like moths to a flame? It's because investing isn't just about logic. It's about emotion, and our brains are wired in some funny ways that can lead us right into these traps.
This slide just breaks it down perfectly. We are hardwired for immediate gratification. A dividend payment in our account today feels so much better than the idea of growth 10 years from now. For retirees, it feels like a real paycheck, which gives them this sense of comfort and predictable cash flow. You know, in a way, it's like financial therapy. It feels good, even if it's not actually good for you. We end up making this critical mistake. We confuse a high payout with the actual financial health of the investment.
Okay, to make this even more clear, let's put MSTY side by side with some, let's call them more adult investment choices. A tale of three ETFs, if you will.
I absolutely love these analogies because they just click. First, you've got VOO, the S&P 500 ETF. That's the disciplined adult of the party, sipping seltzer, totally focused on slow, steady long-term compounding. Then you've got SCHD, a classic dividend growth fund. That's your stable, maybe kind of boring, but incredibly reliable spouse. And then you have MSTY. MSTY is the unreliable friend. They show up with a ton of cash one night and it's a blast, but you know they're probably going to blow it all and need to crash on your couch the next day. It's exciting, but it's unpredictable and super risky. And this quote, a little gruesome, maybe, but it is the perfect summary. If your goal is alpha, which is just fancy talk for beating the market and getting real long-term growth, then MST is simply the wrong tool for the job. It's not designed for that, and trying to use it for that purpose is just a recipe for disaster.
Now, after hearing all that, you're probably thinking MST is just complete and utter garbage, but that's not totally fair. It is a tool. A very flawed, kind of leaky tool, but a tool nonetheless. So let's look at the very specific, very niche situations where this thing might actually make a little sense.
So who is this really for? First, retirees who are laser-focused on generating cash to live on right now and who are okay with their initial investment not growing or even shrinking. Second, we'll call cash flow fetishists, people who just get a huge psychological boost from seeing those dividend payments, even if it hurts their total return. And third, and this is probably the most sensible use case, is as a tiny slice of a much larger portfolio. Think of it like hot sauce. You don't make a meal out of it, but a little dash can add some spice. And I mean a little dash. All right, let's bring this all home. Time for the final verdict. At the end of the day, there is one metric, and only one, that cuts through all the marketing hype and tells you what is really happening with your money.
This is where the rubber meets the road. With something like VOO or SCHD, your money is compounding. It's growing and building on itself over time. With MSTY, it's a totally different story. Yes, it's stripping yield, but it's doing that by slowly eating itself alive. The dying cow analogy is stark, I know, but it is brutally accurate. You're getting a lot of milk really fast, but that cow is not going to be around for very long.
And this right here is probably the single most important takeaway from this whole thing. What looks like a magical golden goose laying golden eggs can actually, over the long run, be a wealth destruction device. You have to look past the shiny dividend and focus on the total return. So I'm just going to leave you with this final question to chew on. High yields are incredibly tempting. The allure of those fat checks is real. But you have to ask yourself, while I'm collecting those checks, what's happening to my actual underlying investment? Is my capital slowly bleeding out? That's the question every single one of us has to ask before chasing a yield that just looks too good to be true. Thanks for tuning in.